The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, more posts by President Trump on social media on Wednesday, seemingly having added impact into a big drop in the cattle futures on the day, with limit lower losses in feeder cattle and heavy pressure in live cattle. Grains and oil seeds a bit more mixed on the session. What are we watching there at midweek? Joining us now for analysis, Mike Zuzolo, Global Commodity Analytics. Mike, good to catch up with you, sir. And I know another busy day in the trade, but glad to have you on for a conversation.
Great to be with you, Jesse. Thanks for having me.
Well, I got to start with cattle. That's the big talk of Wednesday's trade, and I'm going to pull this up on the video feed. The post from President Trump on his Truth Social account midday Wednesday. We were already seeing a lot of pressure in cattle futures, but I think this kind of just was the tipping point on the day. Heavy losses. So much talk about what the administration's plans are for lowering beef prices and talk of Argentinian beef imports, et cetera. I guess, Mike, your perspective, or put this into perspective for us from a market standpoint, just the market reaction we've seen in cattle here on Wednesday.
Yeah, I mean, my take here, Jesse, is twofold. Number one, this Truth Social post helps support the idea that I think we talked about last week, about the idea that President Trump's move in his beef policy to cool prices heading into 2026 is similar to what he did with the egg prices earlier this year. And so I think it's very sincere that he wants to lower retail prices. This obviously Truth Social post did make a lot of sense to me, but I think there's a lot of discussion going on in the policy arena, and hands are tied with the government shutdown. And so I would suspect I'm going to chalk it up to that. Be that as it may, to the producers out there, we really need to realize that maybe he is sincere about wanting to cool retail prices down and taking a page out of the playbook of the eggs. I believe that to be the case. Number two, I'm still on track with the idea that I'm going to play this year like 2014 heading into the holidays. We made a big top in 2014 in October. The cycles this time around that I utilize are suggesting the same thing. We've talked about that. I'm going to go with these two things heading into Thanksgiving, and I'm going to do it with hedges. And the first thing you may be thinking was, well, we just lost our markets. Our markets are dead. Well, it's interesting because I wanted to figure out what the price was now at 365 versus what the high was, and the high was 381 earlier this month for lead month feeder futures. It's only $16 off the highs as of Wednesday's close. We're not far off the highs. We're still very profitable, and I would add to it, and then conclude with this thought: if I'm right about a correction in this market heading into the holidays, and similar to 2014, let's say there's a 15% correction as an arbitrary number, that would take you down to about 325 in lead month feeders. That's definitely, in my experience, hedgeable. That is a number to go after. As far as we're at 365, we could go down to 325. That $40 theoretically is a hedgeable number to go after. And there are hedge tools to go after that number, in my opinion. So number one, all is not lost. And number two, take President Trump seriously and act like it's going to be 2014. And then by the time we get to Thanksgiving, Christmas, I think we'll know whether we're on track for that or not.
Oh, great perspective on that. And I want to take a look at some charts and put this a little more into perspective. And let's look at a chart you sent over. And this is looking at Dees live cattle, no feeders, and December hogs. And obviously we could see on the video feed some of the pullback and correction we've had now in the last couple of days with this news and this talk of, are we going to bring in Argentine beef imports and things like that? So, I mean, when you look at all of this from a chart perspective as well, what stands out to you? What else would you add from a chart perspective, Mike?
Yeah, this may not be new information either. I'm really concerned about the momentum shifting and the sentiment momentum shifting to more of a sell bias by the managed money funds, especially given the fact that I continue to hear on both sides of the Corn Belt, whether it's Northeast Kansas, which I heard just from a great client this morning on that his yields were flattening out, or a couple great clients in Illinois, one near Kankakee, the other one about 75 miles due west along I-80. They too saying that their yields are not working or finishing to the level that they want them to be. So I feel fairly confident to the point where I went below 184 on my national corn yield this week with my producer and clients and subscribers, Jesse, that I really do think we want to be careful about the corn coming in and adding to the negativity in this market when it comes to the feeders and the funds. And so you see the green ellipse on this chart. That's your August, September highs. We're starting to eat into those now as we close out the Wednesday trade. The big number that I'll be looking at on the sentiment momentum mindset is the September feeder lead month low on a monthly chart back in September of 349.72. So let's just call it just below 350. If we go below 350 on a monthly close in October, with October feeders going off the board, October fats going off the board, I think that could change some momentum and open up the downside, potentially give us that next leg down towards that 15% arbitrary correction of around 325. There's some big trend lines around that 320, 325 level as well. That's why I kind of been talking about it.
Well, I do want to throw in the cash conversation here as well for cattle, and another chart looking at negotiated cash cattle versus lead month futures. This is the other piece of this equation as well. What is happening in the sale barns and in feedlot country? I know as of Wednesday, very quiet bids, asking prices, nothing really established. I'll be curious to see how we end the week, but what is the cash piece of this equation telling you in this cattle market, Mike?
In the fat cattle market specifically, because we've only talked about feeders to this point, it's upside down. I would rather have a cash premium at this point versus a futures premium. And as you see in the futures, we closed October around 239. Our negotiated cash price dipped from about 240 down to about 233 on Wednesday mid-session. We'll see if that sticks, but that's going to be really critical because, again, at the end of this month, we're going to see the October fats go off the board. And so what technically what I would like to see and kind of psychologically what I would like to see is a feeder and fat cattle premium in the cash market, not the futures. And in the fat cattle situation, the case of the fats here, the blue line, which is your futures, has a premium of about $6 if that negotiated cash price doesn't bounce real quickly.
I want to go back to the feeders here a little bit. I'm jumbling around some of your charts you shared with me for the conversation today, but thinking about feeders, and you brought up the corn piece a little bit ago, and looking at that monthly feeder cattle corn future spread trade right now, what are you going to be watching closely here as we head to the end of the week, end of the month, et cetera, Mike?
Yeah, last week I think it was, we talked about this, and we were at about 90 times plus percent, 90 times the price of feeders from corn. Now we're at 86%. That's what that white line, that ratio tells us. So again, we're not that far off our highs. The most important piece of this, I think, Jesse, goes back to that September low, and you can see it on the monthly feeder bar chart, is you've got the really wide range that we've established here this month of October, shooting up to that 381 level. Now, all of a sudden, we're back into the highs of August and September, like we talked about before. Notice on this chart that September low, that's your last red bar. You go below that September low, what do you have after that? And this is where you kind of open up the downside until you get all the way back to either the August low or the July high. So this is one of those markets, because we've gotten so frothy, because we've priced in a lot of bullishness. We need to feed the bull here seasonally. We really got to watch these charts closely, because the funds, I think, tend to work those charts very closely, associating the volume, open interest, all those things together when you take out new highs or new lows.
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on Market Talk. Mike, let's go over to the grains and oilseeds. We spent a lot of time on the livestock here to start the conversation today, but let's go talk about this grain trade, which was, I'd call it fairly mixed. We maybe lost a little bit of strength into the close on the day, but overall, quiet day. Let's start with looking at wheat versus crude oil. I love when you share this correlation with us. Talk about just, we always think about crude as a bit of a canary in the coal mine, so to speak here, Mike. So when you look at crude along with SRW wheat, what trend stands out to you here this week?
Yeah, and it's good we talked about the cattle and feeders, gave them plenty of time because, quite honestly, Jesse, not a lot's changed here in the grain markets this week. We've had a lot of news. We've had a lot of good trade news, a lot of not so great trade news. But what we continue to see until we got to Wednesday's trade was the continuation of the market focusing on this oversupply trade of beating WTI down, beating SRW wheat down, and those two running still at about an 87% positive relationship over the last 5 weeks. If I would narrow that to the last 4 weeks, it'd probably be over 90% positive price action. But this is your oversupply trade again, and reiterate the idea that once we can break clear from this, I think that opens up the door, especially in terms of corn. I was asked several times this week by clients and some other ag media people is, okay, if you're so friendly to corn, what's your upside? If you can get this chart to turn around for the wheat and for the crude oil, I continue to feel like the supply demand fundamentals, both globally and domestically, justify either the D corn, the March corn, the May corn, or the July corn being able to get into the 460, 465 area just based upon global and U.S. supply demand fundamentals. Another terrific week when it came to the ethanol numbers, our ethanol production number, best since June 6th. Our stocks were driven down to the lowest level since late October of last year. But clearly what this trade continues to show me is that if the crude and the wheat don't go higher, the trade is more worried about oversupply in 2026. I don't think it's justified. We shouldn't be near a 5-year low in wheat. We've got a stocks to use level that's the second lowest since 2014 at 32.5%. The stocks globally by themselves, not even factoring in demand, is about the fourth lowest at this point. And last year at this time, if you look at this chart, you look at the soft red wheat chart in purple, last year at this time, we were trading around 575. So we are well off where we were last year at this time.
And I'll make a comment here about the crude oil, and if you have some thoughts, you can please add on here. But I haven't seen a whole lot of oil folks, oil pundits, whatever you want to call them, a lot of folks talking about crude oil prices being in, the high 50s, the 57, 58 range. And, it's something to that effect, to that point, to where if we start to see those folks talking about this, and maybe I've just missed some of the chatter, if that starts to, we start to see the ball rolling on crude going higher, can it pull wheat, corn, beans, pull everything with it? I guess I haven't seen a whole lot of that chatter yet, Mike.
No, I agree with you. And, two things pop out with that excellent point. Number one is we just got done making fresh record highs over and over again in gold and silver. Why aren't the rest of the commodities like crude doing it? Number two, more to what you're talking about, is I have seen the balance sheets for some of the big frackers start to turn kind of red as we've gone below $60 a barrel in New York and stayed below it. I personally think that there's an attachment to this price going below $60 and to what the API did on Tuesday as far as putting out a press release saying we're essentially backing out of our agreement on what we talked about when it came to big oil and big ethanol getting together with E15. I think the big oil people are getting squeezed right now at these prices, and I think we are getting some anecdotal evidence of that. At least that's how I read that update from API.
That's an excellent point as well. Forgot about that piece of news amid everything else going on. Let's talk corn soy spread, and then we'll bring it to you for some final thoughts. Just as you look at some of these spreads, and we touched on this last week and more with the lack of government data and more, a lot of folks are having to really hone in on the spread activity in these markets to give us an idea of what's under the surface. What stands out to you with the spread trade right now?
Yeah, the big thing about this spread right now, Jesse, is that I think the corn is really depicting well what I'm hearing out in the fields, as we've talked about here already. And also, I think it's depicting very well that corn demand not backing down either domestically or on an export front at this stage of the game. And so getting back to a negative 27 cents, where the July is only 27 cents premium to the DEES, that gets you back to the best level since May of last year. And so the spread is suggesting A, the farmer's doing a good job of storing the corn, and B, the demand is still strong, and C, again, I think those yields are tapering off here as we get to the second 50% of the corn harvest. And it would make sense with the August weather and with the idea most of my producers told me 45 days ago, my best corn is going to be my earliest corn. On the soybeans, a little bit different situation. It's improving, no question about it. I think we've gone from about negative 69 to a negative 51, a very welcome thing to see in the Nov July bean spread. I think there is one big hoop, though, we have to go through. And next week at this time, we'll probably be talking about it. And that is the delivery process of November soy futures. Is the Chicago price on the board of the 1040, we'll call it 1040 area, is that the right price for the cash market, or is it less than that, or is it more than that? And the delivery process tends to move pretty one-sided because it's seller's choice. And so if the seller who's holding the beans sees the Chicago price as better as versus what he can get out there in the market, he'll deliver those beans and even take the charges that he has to take, especially if you're around central Illinois and around the rivers. And so this is nice to see this week, but I'll breathe a bigger sigh of relief getting into the delivery process and not seeing the November beans pull back. And, the last thing I'd say as far as a closing comment, I really haven't shifted on my mindset about a U.S.-China trade agreement. I really do see this as a long shot at this point. I think the Chinese will come around and buy naturally, probably in the Jan-Feb time period, or if we see the weather really develop in Brazil as far as a drought or some kind of a weather event that they feel like they need to get some extra bushels bought just to safeguard in case the weather gets worse.
Well, and Mike, I do want to throw this thought to you as well for closing comments. Again, with everything going on, it just comes back to risk management, and we say it over and over and over again, and we stress it to folks. And I know it's a tough conversation with some of the price structures right now, but it's so important because as we have seen now time and time again, these markets are trading off headlines, algorithms, all these different things, and the rug can get pulled out from underneath you in a hurry here, Mike.
It can, and I've had a lot of discussions here this week with cattlemen about options and the strong sense that they share with grain producers and how options don't tend to work. And I will say, number one, there are ways to improve the likelihood of those options working, and I can talk to you about that. Number two, I think we need to go back because we're going back in terms of the way the markets are structured, Jesse. We need to go back to the way why the options were created, and that was as an insurance policy. When I was taught in 1995 about futures and options, in the options market, you did those instead of futures because you didn't know whether you were right or wrong, but you needed that insurance policy. And you didn't mind if the options decayed because you were right on the other side of the market. I think we've totally gotten away from that. And I'm not saying producers need to get completely back to that, but I do think you need to integrate that back in somewhat to your risk management program. So I appreciate you bringing that up.
Absolutely. And we always remember that risk of trading futures and or options can be substantial. Mike, if folks want to contact you, reach out, have a conversation, what's the best way?
Best place to go is globalcomresearch.com, and you can take a look at the website and sign up for a 2-week free trial with just answering a couple questions like your name, your phone number, and your email address, and I'll be happy to send that to you for free for 2 weeks and then get in contact with you at the end. And always feel free to take the toll-free number off the website and give me a call either in the morning or after the market closes.
Globalcom with 2Ms research.com for more. As always, enjoy the conversation. Mike Zuzolo, Global Commodity Analytics. Thanks for joining us today on Market Talk.
Thanks for the service you provide, Jesse. Appreciate you being part of this.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.